If you're watching the news about the war in Iran and wondering what this might mean for your investments, you're not alone. Times like this are scary, especially if you're approaching retirement or you're already retired. The good news is that history suggests that events like this rarely damage long-term investors the way people fear. In this video, I want to do three things. First, to briefly explain what's actually happening. Second, look at what history tells us about markets during a war. And third, talk about what long-term investors should realistically do right now. So the US and Israel launched a large-scale military operation. The targets include Iran's nuclear program, missile infrastructure, and elements of leadership. Iran has responded with missile and drone attacks against U.S. bases in the Persian Gulf area and against Israel. In other words, this isn't a symbolic strike. This is a genuine military conflict, and it's evolving quickly. We also want to acknowledge the human reality of what's unfolding. This is a serious conflict, and reports of casualties are very sobering. We don't minimize that. But our responsibility to you is to help you understand what this means for your financial life. What to expect. Here's our honest view of three ways this could unfold. Worst case, the conflict escalates into a prolonged regional war. Iranian proxies land strikes that kill American personnel. Houthi attacks resume in the Red Sea, and oil shipments in the Strait of Hormuz are disrupted. In this scenario, the S&P 500 could drop sharply. Oil could spike to $120 to $140 per barrel, and volatility could remain elevated for weeks. This scenario is possible, but it requires sustained, uncontrolled escalation, and it's not our base case. Base case, the U.S. achieved its military objectives within a few weeks. A ceasefire framework emerges, probably brokered through Oman like it did following the June 2025 strikes. The Strait of Hormuz remains open. Markets drop modestly. Oil spikes briefly, and then both gradually stabilize. Volatility remains elevated for 2 to 4 weeks before the focus returns to what actually drives markets long-term, corporate earnings and the economy. This outcome aligns with the historical pattern following most modern U.S. military actions. Best case, the operation is swift and decisive. The Iranian regime is significantly destabilized. The price of oil declines as supply fears fade. Markets dip initially, but recover sharply within days as investors recognize that a nuclear threat that's hung over the Middle East for 2 decades has been materially reduced. An earnings season continues uninterrupted. This scenario is painful briefly, then potentially quite positive for markets. Right now, we believe the base case is the most likely outcome. And if history is any guide, markets tend to stabilize more quickly than most people expect. But before we get to that, it's worth looking at what actually happened the last time the U.S. went to war. What history tells us. Geopolitical events feel permanent when they happen. Markets have consistently treated them as temporary. I know that right now it might feel like everything is different, that this time is worse, more dangerous, and more uncertain than before. That feeling is understandable, but it's worth stepping back and looking at what history actually shows. Historical market data shows a remarkably consistent pattern from the Gulf War in 1991 through the June 2025 nuclear strikes on Iran. In 9 of those 12 conflicts, the S&P 500 was higher 12 months later, in every case where the economy was not already in a recession when the conflict began. The average return 12 months after a U.S. military engagement is approximately plus 10 to 11%. The average 18-month return is roughly 15%. The Gulf War, which was terrifying at the time, was followed by a 29% gain over the next 12 months. The Iraq War, widely feared as a catastrophe, was followed by a 34% gain. The one exception is 9/11, but the important context is that the U.S. economy was already in recession before the attacks. The conflict accelerated but did not cause that downturn. Today's economic backdrop is meaningfully different from 2001. The economy is not in recession, earnings are healthy, and the financial system is sound. The longer view. Could this actually be a turning point for the better? I want to share a perspective you may not hear much in the media today, given an understandably intense focus on the immediate violence and uncertainty. But as an advisor who thinks in terms of decades, I believe it deserves to be said. There's a genuine possibility, uncertain but real, that what's unfolding today could ultimately lead to a more stable Middle East and a better life for the Iranian people. Before these strikes, Iran was already experiencing its largest wave of popular protests since the 1979 revolution, spreading across more than 100 cities, fueled by economic desperation and deep resentment of the regime. Thousands of Iranians were killed by their own government security forces in January alone. The regime was fragile. Many Iranians are expressing hope. If this conflict accelerates the end of a regime that has sponsored terrorism, suppressed its own people, and pursued nuclear weapons for decades, the long-term consequences could be significant. Iran has a young, educated, cosmopolitan population of 88 million people and vast energy resources. A post-theocratic Iran reintegrated into the global economy could represent one of the most significant economic opportunities in a generation. The broader network of Iranian-backed military groups, Hezbollah, Hamas, and the Houthis, depends on Iranian state support to function. That network fragmenting would reduce risk across the entire region. The removal of a credible nuclear threat from the Middle East would reduce the long-term risk premium that's been embedded in energy markets and regional assets for decades. And we're not predicting this outcome. History has taught us humility about regime change. But we are watching, and if it unfolds, the implications for long-term investors could be meaningfully positive. What you should do. Our guidelines for you right now. After everything we've just shared, here's our simple, direct advice. Do not make decisions based on fear. The investors who sold after 9/11, after the Iraq invasion, after the COVID crash, most of them locked in permanent losses and missed the recovery. Your long-term financial strategy was not built to be abandoned during a difficult period. Do not check your portfolio every hour. Checking compulsively just increases anxiety without improving outcomes. Do reach out to us if you're worried. That's exactly what we're here for. If you have questions, concerns, or just want to talk through what this means for your specific situation, please call or email. We'll make time for you. Trust the plan and trust the process. Your portfolio exists to help you reach your goals. One geopolitical event, even a dramatic one, does not change those goals. Consider your personal goals and risk tolerance before making any changes to your investment strategy. Please consult with us or another advisor for guidance specific to your situation. In closing, markets have faced moments like this before: the Gulf War, September 11, the 2008 financial crisis, COVID. Each time the headlines were terrifying. Each time, disciplined investors who stayed the course were rewarded. We don't know how the next days and weeks will unfold. Nobody does. What we do know is this: the economy is sound, earnings are healthy, and history is overwhelmingly on the side of patient, disciplined investors. Reach out if we can help.